Welcome to episode 7 of the Cash Flow Connections podcast. The topic for today is legal structures and documents and their implications. There is a categorical difference when it comes to investing in securities, and investors need to understand what they're getting into. There's usually restrictions on how to transfer your shares. There's restrictions on how much control you have over the asset. So we're going to talk about that and what a PPM is and when to use it. We're also going to take a look at some of the different languages used in distribution schedules and how this can make a big impact in your investment over the long term. We're also, of course, going to listen to some horror stories and how you can avoid them as investors. Now, it's important to remember, even though we do have an attorney on board today, we, of course, are not offering legal advice of any kind. Always consult with your own personal legal counsel prior to making any investment decisions. But if you're interested in this topic, it's going to be a great episode. Let's go ahead and get straight to the interview. How's it going, everyone? Today our guest is Peter Fischer, who is a shareholder of Enestein, Ribakoff, LaVina, and Pham, which is a national law firm that has a background in virtually every type of legal transaction that exists. Peter specializes in corporate and securities law and helps clients in transactional real estate, including acquisition, syndication, fund formation, development, leasing, construction, and other financings. He has represented developers, investors, borrowers, and lenders in all product types, including multifamily, senior care, retail, industrial, medical office, residential, as well as self-storage and mobile home parks. We work with Peter on countless projects, ranging from simple contract drafting to full private placement memorandums, which we will certainly get into shortly. So, Peter, thanks a lot for coming on the program today.
Well, thank you for having me. I'm happy to be here.
Awesome. So before we jump into the nuts and bolts of the episode, tell us a little about your expertise in commercial real estate and a little bit about your background in that asset class.
Sure, absolutely. I've been a corporate and finance lawyer for a long time. Gosh, I guess about close to 15 years or maybe even a little more. And I started off doing all different kinds of financings, bank financing, large project financings. I moved out to LA about, I would say, seven or 8 years into my career. Moved out from New York and really started getting involved in some syndicated investing and real estate stuff here, kind of a more middle market practice. And personal investing as well when I moved out to Los Angeles. And I worked on some larger projects like the development of LA Live, and then sort of moved away from kind of the bank financing stuff to representing more borrowers, including real estate developers and syndicators.
Okay, awesome. So we definitely have a bunch of really detail-oriented questions to get into today, but before we jump into those, I want to kind of give some big picture perspective so some of the newer listeners can kind of have a framework in which this conversation is held. So generally speaking, what is a real estate syndication?
The easiest way to describe a real estate syndication is just that it's one individual sponsor who finds a project, let's say it's a multifamily apartment, and pools money from a group. It could be, anywhere from a handful to upwards, into the 70s, 80s, 100s, what have you, pools a bunch of money from a bunch of passive investors to fund that project while the individual sponsor is sort of the, developer or, sponsor, if you will. They're putting the project together and using other people's money, basically.
Got it. And so there's a really key difference between this structure and a typical joint venture, which will also use other people's money. Tell us a little bit about the really main difference between a syndication and a joint venture.
Sure. So typically, a joint venture also is a sponsor and then money on the other side. But typically in a joint venture, you will have one or maybe two, but typically one large financial partner who, if they're not putting in the entire equity for that deal, they're putting in nearly all. And so that will be a life insurance company, a pension fund, or potentially a high net worth individual, or maybe a private equity fund. But the key difference is there's one versus a number of financial partners, and that one person often is able to have a lot more control and make a lot more decisions alongside the sponsor. That's sort of the key difference.
Right. So the control is really one of the ways that it differentiates between being a joint venture and not, as well as the number of investors. And the control itself is kind of how it defines itself as a security. So when you're working with syndications, you're dealing with securities, and this is categorically different than not working with securities. So from a legal perspective, what are some of the benefits of investing in a syndication structure as opposed to a one-off singular investment like most people invest in buying a property? They just purchase one property. They're the only owner. They may hire a property manager. What's the difference between that and a syndication from a legal perspective, like some of the benefits?
Sure. So when you're investing in a syndication, again, you're pooling your money with others, and you're also sort of combining, your resources with, let's say, an experienced sponsor. So if you were to try to purchase, your own real estate asset, you might be able to maybe purchase, a triplex, let's say, versus going into a syndication with others who are purchasing a, 100-unit multifamily building. And if you're newer to real estate investing, you may not actually want to purchase your own asset. You might want to find an experienced sponsor, team up with others where you can pool your money and resources and others' experience as well. So it's a lot about leverage. It's a lot about learning. It's a good way to kind of dip your toe into the real estate world. And again, some people, they don't want to deal with, the stuff that the landlords or the sponsors have to deal with. They just want to be, fully passive investors.
Right. That makes sense. So you can defer to other people's expertise. You can rely on their track record, their time, and stuff like that. But then also something that I have noticed as an investor as well is when you're dealing with securities, there is a major difference in the punishments, and there's a criminal component if you have a bad actor when it comes to securities. And I have found that when you invest in syndications, your leverage, because of the fact that these securities are in question, the leverage over a particular sponsor is much more favorable, as opposed to if you're just investing in a single family property and the property manager, defrauds you for $1,000. This is very different for than if a sponsor defrauds you over $500,000, because cumulatively you and the other investors will have it makes more financial sense economically to actually pursue the person in that instance. And there's a myriad of different lists I can go on as far as those two differences, but that's one I've found as well. When it comes to, I mentioned earlier the private placement memorandum, when is it appropriate to use a private placement memorandum as opposed to just a typical contract?
Sure. So a PPM or a private placement memorandum is really a big disclosure document, and it's really the document by which you would make an offering of the securities that are being purchased in your syndication. A lot of times you get a question of, do I need a full PPM? Do I need just an operating agreement? Is there something in between? And sort of a general overview is if you have any non-accredited investors, and there's a certain formula in Reg D, certain dollar amounts of income, assets for the investor. But if you have any non-accredited investors, you really do need a full private placement because the disclosure requirements are such that it's really akin to what a public offering disclosure document would look like. So putting that aside, the question then becomes, if you have all accredited investors, do you use a full PPM? Do you use an operating agreement with a disclosure exhibit on the back, which is the so-called, PPM light type document, or can you just simply prepare an operating agreement and not have any disclosures because you're using only accredited investors? And the answer to that is something that everybody hates to hear from their lawyer, which is it depends. My general answer is typically you don't want to use simply an operating agreement, and you don't want to not have any disclosures. Now, the reason for that is because even though if you have all accredited investors, there's no specific disclosure requirement, and the operator is sort of tasked with preparing, whatever disclosures it may think it needs, you still have sort of a so-called materiality threshold kind of as an overview, which basically means, is there any fact or omitted fact which, would create a substantial likelihood that a reasonable investor or reasonable member or shareholder would consider it important in deciding how to, whether to invest. That's pretty amorphous, and what's a reasonable investor. But the idea is, look, if you are investing in a multifamily property and it was built on a property that used to be a gas station, well, that's pretty material. So as a attorney who often represents sponsors, I rarely put together a deal or rarely counsel clients to not have any disclosures at all. And if you are an investor, I would say if you see if you're presented with a package, that has no disclosures and it's just an operating agreement, you might want to think twice about it. However, and this is where the it depends part comes in, there are other factors like how many investors are in the deal, how well the sponsor knows those investors, meaning, are they all friends and family? Are they repeat investors who've invested with that sponsor many times? So the more familiarity you have with your investors, the more they are, a handful, friends and family, sort of the more, I don't want to say appropriate, but I would say possible it is to simply present those people with an operating agreement, have them sign it, and sort of verbally maybe explain all of the material items, or give them a separate executive summary or something. But you would almost never do that as a new sponsor. A new investor going into a specific deal where you don't really know the sponsor, you don't have an exact idea of what the property is. So again, it depends, but I think it's much more rare, and I almost never, we even have clients who are buying 100, 200 unit apartment buildings from all accredited investors and people who have invested with them before, and they still, use a full-blown PPM because it's a big insurance policy, right? So it's, 100 pages or whatever it is of disclosures on, what could go wrong, why, there may be environmental issues, we may not raise the capital, et cetera. And the more you disclose, the better. Now you balance that with what are my investors expecting to see, legal costs, et cetera. And I know there are some very successful operators who have used solely operating agreements, but again, I think it's kind of rare. So that's the long it depends answer.
Got it. Okay, cool. And so basically what this PPM is the document, the one singular document that mostly outlines the risks of this potential investment. However, inside this PPM, there's a couple different pieces. There's the risk disclosure segment. There's also the subscription agreement, which is where investors actually sign their name, and commit their investment amount. And there's also the operating agreement, which kind of outlines the way in which the entire investment is going to be conducted. So from a big picture perspective, in these operating agreements, in these PPMs, how are these generally structured?
So in the full PPM, you'll have the disclosure section, you'll have a sort of business plan section, you'll often have bios, you'll have an explanation of the actual operating agreement, the way the waterfalls work. And then in the PPM Lite, you kind of just have the operating agreement and then the sort of risk disclosure piece, kind of on the back of that. So that's sort of two ways that this can be presented to you. But in any event, the way that these syndications typically work is that you will have an investor class of shares. Let's say that's the A class, and actually mostly they're limited liability company interests because they're in LLCs and not companies, but I'll say shares, just meaning equity. But so you'll have a class that is the investor class, where the sort of passive limited partners are coming in and putting their money. And then you'll have a B class or manager or sponsor class, which is usually, sometimes the sponsors put in money, cash money as well, but they're really getting it's called a promote for putting the deal together, sponsoring the deal, amalgamating all of the investors together.
Right. And that distinction is really important for a lot of reasons. If you are investing as a passive investor in the structure Peter just mentioned, if you're investing in the A shares, you are a passive investor. You don't have a lot of decision-making skills, decision-making powers. You're also not going to be typically held accountable for the liability or credit in which the property is being conducted. So the distinction between the A shares and the B shares is really important, because you get to get the benefits of investing in real estate, but you're very minimalized, if not completely eliminated, from those type of risks that go along with investing in real estate when you're investing passively. So in that explanation, you mentioned the distribution schedule. What are some of the items investors should make sure to review when it comes to the distribution schedule?
Yeah, I mean, the distribution schedule, the so-called waterfall, is kind of one of the main pieces, if not the main piece, that investors will care about, because it sort of sets forth what your potential returns are going to be, how and when you get your money, if there's a difference between the way that distributions are made, from, let's say, if it's a multifamily property, from the operations, meaning the rental income, is that distributed quarterly? Is it distributed monthly? And then oftentimes there will be a separate waterfall for, what happens and how proceeds are distributed when that particular asset is sold, let's say. Typically, there will be a preferred return, some sort of initial chunk of money that is distributed, let's say, only to the Class A shareholders or members until they get an 8% return, for example. And then there will be a split. It's often, there's a hurdle, in other words, as the first step in the waterfall, whereby all of the money is going to the investors, and then the sponsor thereafter will share after that point.
Got it. So just to give an example, so you mentioned the 8% preferred return. What this means is that if an investor invests $100,000, they are expected to receive, or they will receive $8,000 on an annual basis prior to there being a performance split in which the sponsor will participate in. And so that would be one thing to look on it for a distribution schedule. Is there a preferred return? What is it? And then after the preferred return, what is the split? And usually we see things anywhere from 50-50 all the way up to close to 80-20, 80 being in the favor of investors. And that's a scale of usually how much work the sponsor has to do. So if a property is fully stabilized, the splits usually go higher in terms of the investors. But if the property manager is having to do a bunch of renovations, if they're doing a value add that could take development or building permits, etc., then the split goes more favorable for the operator. So within the distribution schedule, there's a couple different ways that capital can be returned. What are some of the major structures you see in which the capital accounts, the investment amount, and therefore the preferred return owed for future quarters is determined?
Right. So these waterfalls take many iterations, and they can get complicated. But one good thing to understand is what counts as, let's say, a preferred return, which is, you're getting a return on the money, on the capital that you've invested in that syndication, versus what is a return of your capital. When do you start, instead of getting your preferred return or sort of, an interest on your money, when are you actually getting a distribution of your capital back? In which case, if you invest $100,000 and 10,000 of that's not a good number. If you're getting $500 and $250 of that, you need to know, okay, that's that'll count as my preferred return. And then this other 250, that's going to be a return of my capital. So the next time I get a preferred return, it's going to be calculated on my initial investment, minus that $250.
Right. And so there are certain structures where anything paid to investors above the preferred return, if it's from operational cash flow, from rents or rental income, it does not count as a return of capital. Therefore, the way that they calculate the preferred return owed for future quarters doesn't change during the life cycle of the fund unless there's a sale or a refinance. However, there's another very common structure where anything above the preferred return does count as a return of capital, and therefore the preferred return owed for future quarters slowly decreases if you're getting capital from cash flow from rental income. So if that's not a little bit too complicated, that's fine. You can rewind it. But I think what's really important here is that there are many different structures out there, and it's important to understand them, especially if you're investing in long-term investments. The way in which your capital is counted as being returned to you can be very important and make a very big difference over the life cycle of the investment.
Yeah. And I think this is, another area. In general, it's important, for investors and their advisors to really understand what your documents say. And this is one of the areas where investors can be surprised later. I think it's rare, but if you have a document that says, if the syndication, if the project needs more money, you may be required to put in more money, and if you don't, you will be in default. You'll be required to buy your interest back at a discount. Other people putting in money on your behalf can have their funds count as 2 times what they put in. I always advise investors, if you see documents that say anything like that, I would not personally invest in that syndication. What is more typical, and what is more advisable, I think, is something like, if the project needs more money, the sponsor can obtain indebtedness, maybe up to a certain amount, or the sponsor can do a capital call in which you may but are not required to put in additional funds. And it's certainly fair that if you don't put in additional funds and other members, other folks do, that your total percentage interest in the project may get diluted somewhat, but there certainly shouldn't penalty or default or anything like that for you not putting in additional money after your initial capital contribution.
Got it. So if there is a capital call provision that says basically, you are subject to our decision as far as when you should put in more money, you most likely should not invest in an investment like that. That's not setting themselves up for success. So another question that we get a lot is, when can investors sell their shares? How do you typically answer this question, and what are some of the typical clauses you see in terms of the transfer ownership of these passive investment shares?
Well, I think, and I always tell the clients of mine who are sponsors, people need to realize, and again, it depends on the asset. It also depends on whether you're investing in one syndication on one property or a fund that's going to be investing in multiple properties. But these are not designed for trading in and out. It's not a public. It's not a REIT. You're not investing in a stock that you can buy and sell. So there are typically transfer provisions which have permitted. They're so-called permitted transfers. You can put your interest in a estate planning vehicle like a trust or certain things like that, but you're not going to be able to go and trade your share on the market. Or even if you find another party to buy it, most likely the document's going to say something like, you are not permitted to transfer your interest unless you go and you get manager approval. And occasionally, if there's a lender or something, you may also need to get lender or other third-party approval. So you need to anticipate, if you're going into a syndication, you're not just going to be able to pull your money out prior to the lifespan of that project.
Got it. And within the powers of the managers, we have the separation of the A shares and the B shares. Within these separations, the managers themselves, what are some of the duties that they should be able to have power without consulting the investors?
Well, the manager and the sponsor is going to typically want to run the project, build it. If it's a value add project, renovate it, do the permitting. They're going to want to be able to do just about everything on a day-to-day basis without any involvement from the investors, the Class A members, other than potentially selling a property past a promised time period, let's say, putting the company into bankruptcy, forcing everybody to sell their interest, major things like that, amending the documents, let's say. Major things like that are things that investors can expect to see that they would have some say on, but otherwise, certainly not the day-to-day operations, who the property manager might be, even selling the property if it's, within the time frame that the investors had expected, the lifespan of the deal to be, let's say. You're not going to be, as a passive syndication member, you're not going to be, at the bargaining table with a potential buyer, or signing up leases or anything like that.
So what happens then if the manager needs to be replaced or is unable to continue to manage the investment?
Yeah, so there are, or at least there should be provisions whereby, number one, you don't want the manager who you are banking on and investing in to just simply resign, and have the ability to say, okay, I'm not managing this property anymore. Or I'm not, managing this LLC anymore. So as an investor, somebody who is investors, I would like to see that the manager isn't going to resign unless, if it's an individual, obviously, if they, have a disability or they pass away, or something like that. But so number one, you want to see that they're going to be in it for the long haul and that they're not just going to resign. Secondly, there should be some provisions for what happens if there are, certain bad boy acts and fraud and other potentially things like that. And how is the manager then replaced? And who does the manager need to be replaced with? Is it, somebody with similar experience? Is it, the majority oftentimes, or a supermajority of the Class A can remove the manager? There should be some mechanism where if the manager does something bad, sometimes it's performance based if the manager doesn't get X return, but usually it's more keyed off of, bad acts of the manager. And how does the investor class replace them, and who do they replace that manager with?
Got it. And when it comes to the reporting that's taking place during the life cycle of the investment, what do you typically see in terms of the requirement for the managers to report to investors?
I would say typically there's quarterly reporting. Sometimes it's more, sometimes it's monthly. I think that's a little bit more rare. Some sponsors now are, they are taking advantage of technology. They're going online. I think there's a group, Origin now, who is you can log in and look at their investments real time, which is pretty neat. But I think quarterly reports and then an annual report, quarterly, sort of 45 days after the end of the quarter, let's say. And then you should obviously be getting all the reporting information that you need to prepare, tax returns. And those returns, they can take many forms. It's great if it's more than just, a piece of paper where the sponsor, writes down what's happening, and it has, it looks more formal, and you can get, rent roll and vacancies, let's say. But you should be getting regular quarterly, if not more, reporting from the sponsor.
Got it. And that's actually interesting, because what we were talking about earlier with the whole different categorical difference between investing in a single investment as opposed to investment in a security. If you have a manager that's failing to basically meet the requirements of the PPM and the operating agreement, it's a big deal, because they're managers of security. So if you have a reporting requirement in there and they're failing to give you those detail-oriented quarterly reports, this is a big deal and can be used as leverage later down the road if something were to go wrong. I'm not sure how often that really comes up, because we like to invest in things that are not really going wrong. But at the end of the day, you want the PPM to outline what they owe you, so that in the event that even if the investment's going well, you want to be able to say, look, it's been a quarter, where's the quarterly report? And it really helps with the education as well as the transparency between the operator and the investor. So I know that you usually focus on transactional real estate, but I do want to ask a question about how investors can avoid a lot of nightmares. So do you have any example of a serious issue that an investor came to you with, or your firm, and how did you resolve this issue?
Yeah, I was. We talked briefly about these questions before, and I was trying to come up with my most nightmare stories. We've had a few, and I thought there are two examples that I think sort of really, can show how these can be dealt with, and B, how they can be avoided. So on the one hand, I had a guy who invested in a syndication with a very experienced sponsor, somebody that I knew, had invested with them before, had no issues, and went through a divorce in the middle, had a liquidity need, came to me with the documents, and he said, oh man, what am I going to do? These documents say no transfers, this, that, and the other thing. So I said, well, yeah, that's what the documents say. But we know the sponsor, so let's give him a call. And sure enough, the documents did say, you can't do XYZ without the sponsor's consent. But because of who the sponsor was, and because we knew the sponsor, they were able to work with him and find another member. That the deal was doing very well. There were no problems, so it was actually fairly easy to find somebody, notwithstanding what the document said, get everybody to sign off on the fact that they were, in essence, doing something that the document said that they couldn't do, and at that particular time they needed a waiver. And because of that particular relationship, he was able to in a tough situation make a transfer and get the liquidity that he needed. On the other hand, I had a new client come in, referred by another sponsor who had invested in a competitor's transaction. And she wasn't getting her reporting. There were clearly some things that were amiss. And as she brought us in, and we did some digging, in fact, found out that this particular sponsor wasn't doing the reporting because he wasn't getting the results. The documents weren't up to par. There was, in fact, there were no disclosures. So we were able in that case to put leverage on the sponsor and basically force them and say, look, there's going to be securities violations. There's going to be a lot more issues if you don't repay our client her initial capital contribution plus some interest, maybe not up to what she was supposed to be getting. But we were able to use the leverage of the fact that, hey, by the way, this is a securities transaction and there's going to be serious issues down the road, if you don't get, our client her funds back.
Yes, and I didn't know that story, but that is exactly kind of the underlying theme of the whole interview, is that this is a really a big boy game. And when I was first introduced to real estate, people were kind of steering me away from commercial real estate because of this. But I have found that this is where I like to invest, because you're dealing with sophisticated individuals, you're dealing with securities, and you're able to leverage other people's time and expertise. But at the end of the day, there is a serious recourse if they don't follow the formal guidelines of the operating agreement and the PPM. So I'm glad that you told that story. Looking at some of the general guidance for investors that are pursuing syndicated investments in commercial real estate, what's some examples, or excuse me, what are some guidance that you can give to new investors?
Yeah, I mean, I think what I would say is, number one, look at a lot of deals. You don't have to, if you're interested in getting into syndications, and somebody hands you, a package for a particular deal, you don't have to invest in the first deal that you look at. It's a really good idea to look at, a number of different PPMs, a number of different packages, see what the different asset classes are. Some people like to physically be able to go to the projects that they're investing in. Some people, don't really worry about that. But there's so many different iterations of preferred returns and splits. I just worked on a project where all of the returns go to the investors, and the sponsors are getting a lot of fees. So there's a lot of different structures, and you should look at a lot of different deals and familiarize yourself with the terms. So that's sort of the first thing. The second thing is, talk to a lot of other people who are investing. There's a lot of organizations, FIBI, for investors, by investors. Surround yourself with other people who are doing, what investing in the syndications that you want to be investing in. I think the third thing is, surround yourself with a really good team of people. Find an attorney you trust, find a CPA, maybe even a wealth manager who's familiar with these, types of investments. Find some, good people that you trust that can advise you and that are experienced. And then, I think that the most important thing is, once you look at a lot of deals and you find the documents that are, well prepared and well drafted, and there's the right disclosures and everything else, the most important thing is to find the right, the documents can be perfect, but if you're not investing with the right sponsor, an experienced sponsor, and a trustworthy sponsor who, is available, is answering your questions, who you've gotten recommendations from other people who they're investing in, you can have documents that, 6 attorneys have looked at, but if you invest with the wrong person, the wrong sponsor, and either they're, shady or they don't have the right experience, the documents aren't going to make a difference. So I think, find the right sponsor, surround yourself with the right people, and just, look at a lot of things and learn a lot, I think is the best advice I could give.
Yep, completely agree. And that's what we're trying to do, is provide that educational content so that investors can be more comfortable, but more experienced as well, because you're just not going to be able to know what you're looking at unless you've looked at a lot of deals. But once you start to look at a lot of deals, you can see not only the way that the returns can vary, but also the language within these legal documents. And I think that's a great note to end it on. Peter, I really appreciate you coming on. I think we learned a lot today, and I'm really looking forward to getting the feedback from our listeners on this one.
Absolutely. Well, thanks so much for having me. And I'm sure you'll tell your listeners my contact information, and anybody should feel free to contact me. I'm always happy to hear from new investors and new folks who are interested in syndication.
For all the listeners out there, thanks a lot for taking the time to listen to this episode. If you're interested in contacting Peter directly, feel free to contact him at pfischer@enesteinlaw.com. That email address will be in the show notes page, as well as his law firm overall. Peter and I have done a lot of work together, and I have referred many clients to him. So if you're interested in getting a new attorney, or you need one to look at some legal documents, don't hesitate to contact him. Thanks a lot.